So welcome back to my channel, guys, and if you like this video, don't forget to hit the like button and subscribe. Greatly appreciate that. And so let's go right into it. I'm going to be giving you guys 3 stocks, pitching it for 3 minutes, and basically the way I'm going to do it is in order from the least risky stock to the one with medium risk, and finally end with the riskiest one. Okay, so the first stock on our list today is Sony. So let's start the timer, and boom. So Sony is very known. Many of you guys probably know it as the manufacturers of the PlayStation 5. Very, very popular gaming system that just came out last winter, and it's virtually sold out everywhere right now. So the reason I bring this up is because that's how a lot of people know Sony, but they're very involved in pictures, so they make a lot of cameras, a lot of media productions. They're very involved in entertainment, in the music industry, and they even have a financial services segment in Japan. So Sony has their arms in a lot of different industries, but I still feel like they haven't gotten enough attention like other American tech companies. So, over the past year, if you've been following the market, many tech companies like Apple and Microsoft, Tesla, they've run up in prices, and the reason is because there's been a very positive sentiment towards tech stocks. This hasn't been the case for Sony, and I don't know why. It might just be because since they're a Japanese company, they're just not getting as much media coverage as these American tech companies. But whatever the reason is, they're still very undervalued as of today. So their price to earnings is 13. In comparison with the broader market, it is 35. So they're massively undervalued if you're just looking at PE ratio. But we don't do that over here. We go a little bit further. If you look at their numbers as well, over the first 3 quarters of 2020, their financial services, their gaming, music, and entertainment segments have brought in 800 trillion yen. So in comparison to 2019, when those same segments only brought in 600 trillion yen, the revenue has grown massively. Their earnings has grown by ridiculous amounts. They've also been consistently beating earnings and Wall Street's estimates. So just in the last quarter, they reported earnings in February. Wall Street estimated that they would have an EPS of 80 cents per share. They ended up reporting $2.64 per share. And if you don't know what EPS is, I'll leave a quick link below. But basically, it's not very often that you see companies beat Wall Street's estimates by 3 times. And Sony did that, and they've been beating estimates in previous quarters as well. So they just have a lot of positive momentum, and I don't mean from people pouring in large amounts of money in it. I just mean from they're just beating estimates. They're releasing new products that everybody wants to buy, and their business model is very smart. So at least for their gaming segments, they rely a lot on subscriptions. So for their PlayStation 5, they're not even maximizing profits. I believe right now it retails for $500. They priced their PlayStation 5 at $500 and their digital version at $400. And in comparison to the production cost of this, they're really not making that much profit off it. Where they really rely on their profit is their subscription services. So people have to pay Sony a monthly or yearly subscription in order to play with their friends, access certain features in their PlayStations. So this causes a lot of recurring revenue for them, and their subscriptions have only gone up over the past years. They continue to grow. Below is a chart of their subscriptions, and some of the risks that do come in with the stock is that lately we have been seeing a global shortage of semiconductor chips, and basically these are the chips that tech companies use to make their products. So for Apple, they use that to make their iPhones. Tesla uses that for their cars. Sony uses that for their PlayStations. Right now there's a shortage for that, but I don't think this is going to be a long-term problem for the company, as there is still strong demand. A lot of people don't have a PS5 yet, and they're just going to continue wanting to buy that so that they can, upgrade and continue playing with their friends. On top of that, they do pay a dividend. It is less than 1%, but remember, we don't buy stocks because of their dividend. It's really just a nice bonus if they do offer one. Let's wrap this quick point up. Sony is very undervalued at the moment. I don't think the market has fully priced in all the benefits from this new generation platform and all the really exclusive games that you can only play on PlayStation compared to their competitors like Xbox. Okay, so the next stock on our list is Costco. And let's start the timer. Boom. So Costco has sold off massively in recent months. It went from $3.93 all-time high in December to about $3.30 today. And the reason for this sell-off is I think many investors see this as a COVID stock. So if you remember, in the beginning of the pandemic, everybody was stocking up on toilet paper and paper towels and cleaning supplies. And basically, I think this led to a lot of buyers at the time, and recently people have been selling off, because the pandemic seems to be almost coming to its end with all this vaccine news and stimulus news. But I think this is a great opportunity for investors because the stock has grown a lot in 2020. So what I mean by that is their sales grew by 9%. And another indicator of low value is a price to sales ratio. So the price to sales basically takes the valuation of a company and compares it to how much it sold. It's been valued at about 146 billion and they sold 160 in revenue. So that's a price to sales of under 1. Typically you want to see a price to sales of under 2 or 3, and a price to sales under 1 just tells you that the company is very undervalued. Also, back to the point of it being just a COVID stock, like many investors seem to think it is, it's not. From 2018 to 2019, it grew 7%. Well before COVID, COVID allowed it to increase that to 9%, and it's only going to keep growing. I mean, some of the risks of the stock is that they are seeing increased competition from other wholesalers like Boxed. So what Boxed is, it's a online wholesaler, so you don't have to go to the store. You can just order the same products you see in Costco online, and it's delivered to your house. But Costco's actually been fixing this problem. So in 2020, they actually increased e-commerce sales by 50%. So these are the sales that you can do online. They have 2-day free shipping for all their members. So if a member doesn't want to go in store for any reason, they'll ship you all the groceries that you need to your house. So Costco isn't just, going to let some online wholesaler take all their clients from them. They're going to combat this, and they're going to continue investing in their e-commerce business.
And finally, the last point I'll make with Costco is they have a global footprint on the world. So they operate in North America, Europe, Asia, Australia, and Latin America. So even though they will face future competition from Boxed and other companies, they have such a strong customer base that I feel that they will be able to overcome this if they continue investing in e-commerce.
Okay, so finally our third and our riskiest stock is going to be Uber. And let's start the clock. And the reason I consider Uber the riskiest stock of the three isn't because, I think, Uber isn't going to survive in the near term. I think this is a company that's going to be around for many, many years, probably many decades. But the problem with Uber right now is that it's very overvalued. So customers have been have a very positive sentiment towards these tech companies like Uber, Lyft, DoorDash, Airbnb, and this has caused their prices to run up. So do I think you should invest in Uber right now? Yes. Do I think you should put in all your money into Uber right now that you have all your investment money into Uber right now? No. I think you should be cautious with it because it's going to be very susceptible to strong price movements. So if you see the NASDAQ going down, you're probably going to see Uber go down. Same thing, if it goes up, you're probably going to see Uber goes up as well. So just to put things into perspective, using the price to sales ratio that we use with Costco, Uber has a price to sales of over 8. And this just tells you how significantly overvalued it is to Costco. Do I think it's justifiable? Yes. I mean, they did purchase Postmates in 2020 to boost their Uber Eats segment as well. So I mean, they're growing in all areas. Right now they operate in over 70 countries, over 10,000 cities. I mean, the app basically works everywhere around the world. And just aside from the fundamentals, it just makes sense as to why you would want to invest in Uber. I mean, you ever go to a party After the party, you're probably calling an Uber to go home. If you go to an airport to catch a flight, you're probably taking an Uber to the airport and to pick you up from the airport. So it's just a very practical investment in my opinion. I think you can't really go wrong here if you're investing for a 5-10 year horizon. I mean, you're probably going to make money just because the app is going to continue to grow. They did lower sales in 2020, but that makes sense. I mean, a global lockdown from March to May, and this is really the reason why their sales suffered. They actually came pretty close to their 2019 totals, and this just shows you how strong the company is. They were able to rebound in the second half of the year and almost matched their same sales total as the 2019 totals. Now, the thing with Uber is you're going to want to see them reach profits at some point. They still haven't been profitable for a full year, but this is typical with new companies. I mean, they're less than 10 years old. I mean, they're a new company. They're investing to grow a lot. Like I said, with their Uber Eats segment, they're still growing within their taxi services. So my biggest risk with the stock is time's up, but fuck it, let's finish. The biggest risk with the stock is going to be mostly just their price movements. You probably don't have to worry about growth here. It's like I said, it's a practical investment. It makes sense. I think many people can see why this is a good long-term investment. But yeah, just be careful with it. Just know that the price can move down 20% one day and then just rebound 10% the next day. So yeah, guys, those are my 3 picks for the week. Thanks for watching. Don't forget to like and subscribe, and always do your due diligence. I know I try to give you guys as much information as possible within 3 minutes. That's why I usually go over it sometimes, but always do your due diligence. Try to invest in things that make sense. I think the 3 companies that I pitched you guys today did make sense. A lot of people use them. They offer very familiar products and services. So, always try to go with what you know. And with that being said, I'm going to see you guys in the next video.